Cool. All right. Thank you for attending the Thursday, November 16th edition of the Team Unstoppable call. We do these calls every couple of weeks across the Team Unstoppable universe to talk about real estate topics that are relevant for those of us who are active investors. And today we're going to talk about private lending, and we're going to specifically look at it from the perspective of a non-U.S. Foreign investor. I know that a lot of the investors in the group are U.S. based, but quite a few of you are outside of the U.S. and looking for creative strategies to accumulate real estate, and this is exactly that. But before I start, I have to pay homage to my graphic here. I always start this way. I just want to remind people that it is the nature of real estate investors that we take some punches. I know I've taken my share over the last 23 years, and I remind myself, and I'll remind you, that we're not dangerous because we don't lose. We're dangerous because we don't stop. You don't lose until you stop getting up. As long as you keep getting up more times than you get knocked down, you'll make it through. So that's just a reminder for all of us in Team Unstoppable that the goal here is not to avoid loss, but instead to commit to pushing through and learning and getting better and networking until you get what you want. And so in that regard, we are, in fact, unstoppable. So let's do some quick housekeeping. It's going to be, I think, a relatively small group, but I can have hundreds of people. So my request is going to be that we keep it informal. If you have questions as I go through the material, by all means, go ahead and ask them. You don't have to put them in the chat because, again, I don't have the kind of skill to watch the chat and move the presentation and talk. So just go ahead and shout it out. But I do request that when you're not asking a question, that you stay muted because we are recording this for posterity. And so I don't want the recording to have lots of background noise. So feel free to ask your questions as you have them, but please don't leave your microphone on while you're not asking a question. We're going to talk today about seller financing and why it is like magic to a non-U.S. foreign investor. Now, for the record, it's like magic to a U.S. investor too, but I'll talk in a minute about why I specifically want to focus on the foreign investors out there. And I've invited many of you to join us. Like we've got folks now from Sweden, from Australia, from Taiwan, from I believe also Australia. But I've invited folks from Israel. I've invited folks from pretty much all over because I want to talk about. Somebody just put something in the chat. I'll leave that later unless it's urgent. I want to talk about how seller financing is going to be a relevant factor, particularly now in the U.S. And I will leave time, of course, for Q&A. So if you, okay, I'll take a look. Oh, okay, cool. If you do have questions about a specific topic that requires a bit more time, I'm going to try my best to leave time toward the end to cover that. So first, I think most of you know who I am, so I'm not going to spend a whole lot of time on this slide. Just kind of the highlights. Most of you know I've been a full-time real estate investor since 1999. You know that I accumulated a rental portfolio worth over $6 million by 2007. You know that I got crushed in the global financial crisis of 2007, 8, 9, 10, 11, etc. And I'm currently active in Georgia, Oklahoma, looking at deals in Texas, Nevada, South Carolina, North Carolina. But my claim to fame is that in the 23 plus years that I have been investing, I have never gone to a bank and borrowed money to acquire investment real estate. I don't do banks. And I think for a variety of reasons, you shouldn't either. And I'm going to show you in a minute why you don't have to unless you choose to. But that frees you up in ways that you cannot imagine. You no longer have to be driven by interest rates or what the Fed is doing or what, all that nonsense. You can pretty much rise above all of that because your fate is no longer tied to interest rates, at least U.S. interest rates. So, and again, I know that there are plenty of investors here on the call, non-U.S. foreign investors, and we're not going to talk a lot about why you're investing in the U.S. We know why you're investing in the U.S. It's a great market. It, in many cases, offers the kinds of stability and opportunity and, frankly, returns that you can't get in your home countries. In some cases, you've got currency risk where let's say you're in South Africa, if you had investments there, you're earning things in a currency that is sliding in comparison to the dollar. The dollar's still doing pretty well. I took the liberty of taking a look at the foreign exchange chart of the dollar to the South American, what was it? Can't think of the country, but I think it was Venezuela or it wasn't Colombia. The chart was ugly. It was almost a straight line down. I think it was Argentina. It was Argentina, and it was just brutal. And so if you're an investor with significant holdings in Argentine pesos, you're watching your currency turn to toilet paper before your very eyes. And if you could get some of that money out of pesos and into investments that throw off dollars, that's a huge accomplishment for you. So I get why investors are coming to the U.S. to do deals. But non-U.S. investors have some challenges that those of us in the States don't have. So yes, you want to acquire U.S. rental property to create maximum cash flow denominated in U.S. dollars. I understand that that's what you want, but you've got some obstacles. One obstacle is that most of your home banks in your respective countries won't lend on U.S. real estate, which is a problem. Two, you are ineligible for certainly all the federal U.S. loan programs like FHA, VA, USDA. Can't get any of that with their low interest and low down payments. And the mortgage options for non-U.S. citizens, while they do exist, for those of you who've looked at those, they kind of suck, right? The interest rates are high, the down payments are ridiculous. They want 30 some odd % down. They still require a bunch of documentation. So it's a painful way to operate, and those high interest rates can easily kill even the most attractive deal. So it's hard to find, especially in an environment like now where rates are going up, it's hard to find a way to work with banks. And yet we all want leverage. We all understand the virtue of having leverage. So enter seller financing. Seller financing, I'm going to define it for you, and I'm going to linger on this one and let it marinate a little bit, because I recognize that this is not something that exists. In fact, I don't think I've found any other country other than the U.S. where this is a thing. I define seller financing as any purchase transaction in which the seller willingly accepts something other than full cash, other than all of their equity at closing. If they're willing to defer any portion of their equity, that is, in my opinion, a form or a flavor of seller financing. And the kind we're going to focus on today is the kind where they're willing to accept terms, which we'll talk about in a minute, in exchange for the sale of their property. But I guess I'll ask the question, and anybody can just don't put it in the chat. Just go ahead and yell out. Is this a thing in other countries? I haven't yet found a country where someone says, yes, we have this there. Is this a thing? Is this a thing in Taiwan or in Sweden or in Australia? Anybody? I don't think so. Okay, I hear deafening silence. So either you guys are all asleep or the answer is no. So the idea that a seller can and might want to, other than under duress or gunpoint, might want to not receive their equity all at once at closing seems to be a uniquely USA kind of thing. And we're going to talk in a minute about why that's potentially valuable both for the seller and for the buyer. But just for those of you who are non-U.S. foreign nationals, just accept the fact that this is in fact, a thing here in the U.S. It happens on a regular basis. And again, I built my real estate investing career on it. So it is doable, definitely doable here, even though you may not be familiar where you're from. So let's talk about how seller financing can help. What's the big deal? And to do that, we're going to first cover a quick example that I'm going to cover in more detail, more of a live example, but I kind of want to put the highlights out here. And for that, we're going to have to talk about some deal analysis. So for those of you who are rusty, this may be a bit of a review for you. But let's talk about an all-cash purchase. Let's imagine that it's a single-family house. Purchase price is $100,000. Renovations plus closing costs are $10,000. Market rent for now, let's just argue it's going to be $1,300 a month or $15,600 per year. And let's imagine that the operating expenses are $6,000 per year. If I tell you just that information, then with that you can calculate net operating income, which is going to be the annual rents minus the operating expenses. And I'm going to ask you to, at least for this first year, allow me the convenience of saying that we're going to ignore CapEx. And I'll say that we can ignore CapEx because normally cash flow would be net operating income minus CapEx. Well, let's just ignore CapEx for now. Let's assume that all of our CapEx is going to be part of that renovations budget, that $10,000, which is the renovations plus closing costs. So at least for year one, net operating income and cash flow will be effectively the same. And that number will be the $15,600 minus the $6,000 a year, or $9,600. Not a bad cash flow. That's annual, of course. Okay, so if we buy this deal at $100,000 with $10,000 in renovations plus closing costs, then our all-in is 100 plus 10, and our cash flow is 9,600. So our cash on cash return in year one is 9,600 divided by 110. If you have your calculators handy and you run those calculations, you'll see that that's 8.72%. Not a home run, but not a horrible deal. Acceptable. Most people would look at that deal and go, that's not a bad return on your investment, your invested cash. Not bad. So let's talk about what that means, what you can potentially do in seller finance land. Seller finance land, same $100,000, but let's say I agree in this case, or I get the seller to agree, more importantly, to, instead of accepting $100,000 at closing, to accept just $20,000 down. Same renovations, that won't change. Same market rent, that won't change. Same operating expenses, that won't change. And my net operating income is still going to be $9,600. However, net operating income minus CapEx minus debt service is cash flow. So I've got to deduct out of that $9,600 my debt service. My debt service, let's for now, I know it's 6% is still low, but just for the purposes of making the math work, let's assume that I have this investor, this seller, agree to accept 6% interest only, which is, nope, that's actually too high. It should be, it is 6%, but it actually should be 6% on $80,000, not $100,000. So that's my bad. So let me just do that math real fast. 80K times 0.06 is 4,800, actually better than. So the debt service on this one is actually going to be 4,800, not 6,000. And so my net, so for the purposes of this, my debt service is actually going to be lower than it's shown here, which means that my numbers are actually going to be better than what they're going to appear here, because my debt service is going to be too big. But you get the idea. My cash flow, therefore, is going to be the net operating income minus my debt service. let's use my numbers here, even though just so that you know that I'm overestimating my debt service. Cash flow is 3,600. My cash and cash return now is 3,600 divided by, so cash flow is way less, right?